On today's Hashi, I'm discussing the potential impact of this week's looming jobs report on mortgage rates, Fannie Mae's updated forecast, both economically and for housing, and mortgage applications for the past week. Today is Wednesday, September 3, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples, Florida. Big week happening as we are looking forward to this August jobs report. That's where we're going to start. Before we do that, let me know where you're tuning in live from. Midweek, first week of September. There's about, I said it yesterday, there's about 60, maybe 75, maybe 80-ish days left of really serious decision making when it comes to housing. We know what happens around the holidays. Nationally, numbers fall off a cliff. There's going to be deals for the top 10, 20% of agents that are active throughout the end of the year. Hey, you got a big book of clients. You're going to be active, okay? If you're an attorney, you're closing deals, you're going to be active. But for new business, for new decisions, for some of those end of the year players, a lot of that's going to take shape between now and say mid-November. So we're getting into the thick of things as we close out 2025, which also means like there's only a few big economic milestones left to get to before we see, are we going to be going into 2026 at that near 6% on the 30-year fixed rate? Well, one of those factors is this week's unemployment or employment rather data. If we remember back to the last big jobs report, we saw a big shift in the market. The market believed all of a sudden, hey, we're going to see rate cuts coming in September, which is about 2 weeks from today when the FOMC meets. And we've now had a meeting at Jackson Hole, the Jackson Hole Symposium, where Jerome Powell has all but guaranteed that will be the case. But this week's employment data will factor heavily into whether the Fed follows through on what Jerome Powell said to potentially ease markets and ease concerns out there in Jackson Hole. Okay, so CEO of One Real Mortgage, Samir Dahiya, is noted last week that rates are near the lowest levels and said that rates have now dropped nearly 0.5% from their January highs. Okay, so we like where they're at, 6.5%, giving home buyers and homeowners more breathing room to explore options. Yeah, that they have. There is more breathing room. But when we look at mortgage applications later today, is that breathing room actually bringing activity to the market? No, I don't think so. I think it's going to be more 6%. Okay, so what we're really clinging on to is this going to go even lower from here? 6.5% has brought some relief to some buyers and maybe some refinancers more than sellers. Ultimately, we need a lot more sellers to enter the market who are going to be buyers on the other end to get transactions going up. We haven't seen that 6.5% is some kind of tailwind in this market. It's quite the opposite. Okay, we're still trending near all-time lows when it comes to transaction, certainly given our population. And so we got to get closer to 6. I believe we got to get a 5 handle for the market to really feel good about coming out and being active in transactions. Okay, much of the momentum is being driven right now that the Federal Reserve is going to cut not only in September, but according to JP Morgan, multiple times throughout this year. So the pricing in that the market is doing right now suggests there's going to be multiple cuts. If it swings the other direction, and in 2 weeks, Jerome Powell says, not only are we not cutting, but we may not be cutting much this year or at all, you will see rates move up. Okay. You could see rates move up if there's a cut in September, but indications that there's not going to be a lot of cuts moving forward. That's what people are like, hey, the Fed cut, but the 30-year fixed rate went up. because the 30-year fixed follows the 10-year closely. And a lot of what's going on in the 10-year is priced into the future of what the Fed is saying or indicating about the future. Just look at this quote here. Sorry, not there because you couldn't see it. I'll get it up here in a second. Okay. This quote that I'm going to show you here is, it reads this: much of the momentum right now is being driven by growing confidence that the Federal Reserve may cut rates later this year. Just last week, Federal Reserve acknowledged that data is moving in the right direction. The central bank is carefully considering a shift that helped cool bond yields. Okay, so what he did in Jackson Hole was maybe something to help the bond yields. It sent mortgage rates trending down as an after effect and became a welcome sign for buyers who are in it right now. But he could say quite the opposite in a couple of weeks in September, and we could lose all of that momentum. Okay, so Friday's job report from the U.S. Bureau of Labor Statistics. This one's crucial. Okay, the last labor report is the one where we saw monthly employment gains slow to 73,000 in July, while some 250,000 reported gains in May and June were erased. Okay, they did revisions for May and June, and we saw May, June, and July all well under expectations for employment. Okay, when we saw that happen, when that happened, the markets believe there's going to be insurmountable pressure on Jerome Powell to start cutting. And Jerome Powell, if he gets any kind of, if he gets a job report that suggests, oh no, we have jobs back, he'll use that to say we don't need to cut as much. So if you're looking for rates to cut, and this is one of those things that it's like hard to even say. If you're looking for guarantees for multiple cuts between now and the end of the year, you're actually looking for a weak labor report coming out this week. If all of a sudden the labor report comes out and it's strong, then you're going to be back into that, what some perceive as a political battle between the Fed and the president. Okay. Now, I know the Fed's not supposed to play politics, but one of the obvious statements that the administration does make is, hey, the Fed made all their cuts leading into an election last year, and then they stopped. And they did do that. Now, you could argue that that wasn't political. It was timing. It certainly was coincidental timing. But if we get a strong labor report that suggests, nope, jobs are fine, that's why this is a consequential week as in regards to how many cuts or how maybe even deep the cut might go in September. If we get a strong jobs report, that gives ammunition to Jerome Powell to say, no, I don't want to cut, because he really doesn't want to cut. He does not want to be seen as the Fed chairman that let inflation take off. Remember, he was wrong about inflation the first time. He called it transitory. That's not a political statement. It's what he said. He was quoted as saying such. Remember, he called inflation transitory, okay, for as long as it took until President Biden to reappoint him. 8 days after being reappointed, the Fed chairman, was when he changed his tune on what inflation was. 8 days after being appointed by Biden, reappointed. Obviously, his first appointment was from President Trump. After being reappointed by President Biden, that is when he started changing the tune, when everybody in the markets economically was like, this stuff isn't transitory. You printed 80% of the US dollar. When the government prints money, inflation follows. And it wasn't transitory. But why did he call it transitory for 6 months, for so long in the beginning? Well, he made a political decision to kind of give some early ramp time for the Biden administration to get out there and spend a little. That's ultimately what happened 8 days after he got that political position appointed to him by President Biden is when he started calling it transitory. Now, I don't want to get into all of that because I know some people get emotionally triggered by those kind of calendar facts. But he's looking for ammunition to hold firm on restrictive rates. He has no love for the presidency. He has no interest in President Trump getting a checkbox in the victory column. He doesn't have any interest in that. Okay. They've had a obvious back and forth. He has sole interest in his legacy. He is a human, not Powell the robot that you see on some of our thumbnails. He is a human who cares very closely about his legacy. And if he gets ammunition to hold firm and try to drive inflation down to his target of 2%, there's a lot of economists that argue we're already there when you take out, lagging data of shelter, when you take out of things like the CPI, owner's equivalent rent, and you just go off of what's happening today. We're already there. In fact, I'd be more worried about deflation at this point than inflation, if you're really looking closely at it. And unless he's worried about deflation, which I think he wants to get to that 2% number so he can take his victory lap. Remember, he leaves in May. He'd love inflation to hit 2%, whether that causes deflation or not, before May, right at May, where he can ride off into the sunset and be remembered as the guy who did it, the Jerome Powell who made that soft landing possible. Okay. So we'll be looking closely for this jobs report. Let's move over. Fannie Mae's got their economic developments for August 2025. This is where they update economic forecasting as well as housing forecasts. So they've revised their real GDP, gross domestic product, outlook for 2025 and 2026 to 1.1% for 2025 and 2.2% on a quarter four basis, okay, for 2026. So prior they were at 1.3 and 2.3. So they're looking at GDP coming down. Now remember, quarter two, we saw a pretty big over expectations GDP print. Fannie Mae saying that's not going to continue. Temper your expectations. Fannie Mae doesn't believe in real positive GDP growth. 1.1% and 2.2% is not good GDP growth. Okay, let's be serious. We should be growing at 3.5%, 4%. This is the United States of America. So 1.3 and 2.3%, particularly with where we're at on inflation and everything else, rates, and we've got these tariff deals and all this other stuff swirling around. These would be really low numbers. These would not be great numbers for GDP growth. CPI, Fannie Mae expects to go up. So Fannie Mae says, hey, we expect that inflation is going to go up to 3.3% quarter four over quarter four in 2025. Consumer price index is the inflation measurement that the markets tend to look at the most. We covered PCE yesterday. That's what the Fed tends to look at. Okay, so this is just in July, they had a forecast of 3% for quarter four over quarter four for CPI. So this is 0.3% higher than where Fannie Mae was just a few months ago. The outlook for 2026 is 2.6%, and that is down from 2.7% previously. So they're a little bit more bullish looking forward into 2026. Okay. And then we've got mortgage rates. Just before we get to the housing update, we'll take a look here at a little bit more of the economic outlook. Remember, GDP in 2024 was 2.5%. So they have an economy growing much slower than last year in the remainder of this year and the following year. PCE, which is the Fed's favorite measurement, they have at 0.9 and 2.2 over the next couple of years. I wonder if that 0.9 was I don't see any way we get to 0.9 and 25. I wonder if that was a misprint by Fannie Mae there. I'll take a look at that afterwards. Again, CPI coming in at 3.3 and 2.6. The 3.3 slightly above where they previously were. PCE chain price index and PCE core PCE, those numbers here coming in a little bit hotter than where you'd want them to be. On these are projections, so 3.7 for this year, 2.4 for next year. So next year, look, Fannie Mae doesn't see much of an issue on inflation next year, but has us closing out the year hotter than they had previously expected, and others. Unemployment, 4.2% is the expectation now and projection from Fannie Mae for this year, and 4.5 for next year. Okay, so what is actual maximum employment? It feels like we're kind of there. Nobody's really worried about 4.2, and I'd argue that nobody would be really worried about 4.5 unemployment. Federal funds rate, they have ending the year at 4.2 and ending the year next year at 3.7. So multiple cuts coming between now and the end of the year, according to Fannie Mae's projection. The 10-year is really above where it sits today for next year at 4.5. That will, the mortgage spreads have gotten better between the 10-year and the 30-year fixed mortgage rates, and they're continuing to normalize, and that's been a huge tailwind for mortgage rates this year. But a 4.5 10-year would mean that mortgage rates certainly sit above where we desire them to move going into next year. So with that, let's look at Fannie Mae's housing forecast as of August 2025. Okay. And let's jump right down to the 30-year fixed mortgage rate for this year. They have us averaging out at 6.7%. So they don't have much movement here from the rest of the year off of our 6.5. If anything, they probably have that ticking up. And then we look at next year, 2026, and Fannie Mae projects that 2026 will be an average year of 6.2, which means you're probably bouncing between the low sixes and somewhere around 6.4, 6.5, according to Fannie Mae. I don't take that as a win. I take that as a possibility for sure. Anything is possible as it comes to rates right now. They've been very volatile and at times hyperbolic. If you look at how many half a point swings and even more than that we've had over the last 3+ years as we've been in a real estate recession. It's unlike normal times as it relates to mortgage rates. You don't usually get those really powerful swings that we've seen. So 6.2 next year would, if you really get the Fed to cut as much as JP Morgan suggests that they will, and as much as the administration wants, that would, to me, not be that big of a win, 6.2 on the 30-year fixed mortgage rate, and it would not unlock this market from a transactional recession that we've seen over the last 3+ years. 6.2 does not unlock enough transactions where you could say, yeah, this market is fluid. There are sellers coming out who are also going to be buyers. 6.2 doesn't get you there. You got to get to a 5 handle from everything that I believe. That's a Byron Lazine projection, not a Fannie Mae projection. Total housing starts, according to Fannie Mae, are going to move down this year 3.4% before moving up 1.5% in 2026, but really staying close to the same level that we've seen here the last year and a half. Single family starts going to end this year down 8%, but move up 1.7% off of that number in 2026, according to Fannie Mae's projection. Multifamily has moved up 9.8% this year on the projection and will move up another 0.8%. Why is multifamily now gaining steam after having the significant drop of 25% in 2024? Well, the rates got so high that builders didn't want to build multifamily, and you saw those starts drop. But now that the rates remain high, it's like, well, I'd rather buy rentals or build rentals rather because more people are going to be renting. Basically, what builders are saying is what I just said. Okay, the transactions aren't coming back for sale if Fannie Mae's right on the 30-year fix at 6.2. So if we got to build something to stay in business, we'll go build rentals, and we'll make Jerome Powell happy. Jerome Powell doesn't care if it's a renter nation or not. He doesn't care about housing. He said as much multiple times. Read between the lines. Total home sales. Here we go. Okay. Total home sales. So this is not existing home sales. The number that you hear a lot about, the 4 million, that basement number that we talk about. This is total home sales. Fannie Mae projects that 4.7 million is going to be the number here in 2025. Okay. That's identical to last year's number. In fact, Fannie Mae has us moving down 0.1% from a historically low number. Now, Fannie Mae says 2026 will be an unlock. So Fannie Mae disagrees with me that, hey, 6.2 is going to move the market. They say 6.2 will, as much as 10.3%, up to 5.2 million on total home sales. I don't believe 6.2 gets us there. I don't believe 6.2 gets a 10% jump on total transactions. I think you got to get a 5.9. Now there's going to be, obviously everybody's financial situation is different. There's going to be people qualifying at 5.9 if the average is 6.2. And so maybe Fannie Mae's factoring that in, that there's going to be enough 5.9, five-handle qualifications to go around to get us to a 10% increase on total home sales. I think to get double-digit home sales, we got to have more consistency at the level of 5.99. Even if it's 5.99, that mental barrier of 5% on total home sales. Okay, existing single-family home sales, they also project a 10% increase next year, 4.5 million. So, I think the big, the future looks bright on one thing here on Fannie Mae's projections. It's that across the country, we'll have 10% more transactions on existing home sales and on total home sales, according to Fannie Mae. So imagine 10% more deals. That's 20% on the sides, or there's two sides for every deal, I guess is what I'm trying to say, in your market next year. What does that mean for your market if you're an exceptional agent? If you're ready for an increase in business, if you know how to generate leads in a growing market, these are going to be things, obviously, that benefit you. If you want to close more deals, there's one place that'll help you do that. And it's at the most reasonable cost of any deal in real estate today. That's BAMX. Go to school.com/BAMX. It's the number one agent community to close more deals. School.com/BAMX. We're going to help you build your brand, generate leads, and close more deals all in one place. You get the community, the consultations, as well as the content delivered directly for you each and every single week. And every single week we drop new hyperlocal content, hyperlocal email templates, as well as the social templates and video scripts and blogs all in one place. Go to the New This Week classroom each and every single day. In the hot sheet, my slides that I'm using right here are uploaded right into the hot sheet classroom. We're going to get into mortgage applications next. Those are all available there for you. Go to school.com/BAMX to help you close more deals and get in position to do just that in this market. All right. Mortgage applications. Okay. We've seen last week, we saw, now coming into a holiday weekend, we saw new, fresh year-to-date lows on the 30-year fixed mortgage. So holiday weekend kind of puts a wrench in that. Are you going to see more buyers or less during a holiday weekend? Well, it's not like it's middle of spring where you have that highly motivated buyer. They can just get going in the middle of September. They've seen that houses have been sitting on longer. The urgency is not like it is in the spring. And that was reflective in mortgage applications. Mortgage applications on the headline decreased 1.2% from 1 week earlier. That's during a week that we saw a new, fresh year-to-date 30-year fixed mortgage low. The refinance index, though, did increase 1% from the previous week. It was 20% higher than the same week a year ago. So we're seeing more and more refinances lately come out to play. Now, the purchase index, the thing that we care about the most, decreased 3% from 1 week earlier. So we finally had the streak, the week-over-week streak broken. But we did see year over year that streak continued, and that streak is multiple weeks now at double-digit levels. The unadjusted purchase index was 17% higher than the same week 1 year ago. So rates declined, yet even with that, at year-to-date lows, we did not see a week-over-week increase. Holiday week, and we're starting to get to that seasonality point where less buyers are coming out. Probably need a more significant swing. Probably need to get closer to Fannie Mae's next year projection of 6.2 for it really to feel like you're seeing a lot of buyers come out. Still a long way to go on the recovery of mortgage applications as it relates to these really low level times, the GFC recovery times, and the mid 90s. Other than that, mortgage applications tend to come in a lot higher than where they are now. Again, the financial recovery and the 90s. So still a lot of room to go. That 10% projection increase on total transactions on existing home sales that Fannie Mae is making for 2026, you would see this number increase and maybe get off of that historically low level of mortgage purchase applications. Okay. 10-year coming in here today to start the day, much lower than where Fannie Mae projects it will be next year. Next year, they're projecting at a 4.5, which just, I mean, that seems like a bad number. Okay. I don't know how else to put that. 4.25 is where we sit today. This is one of those, one of those pieces of the puzzle that's helping the 30-year fix. The spread between the 10-year and the 30-year has normalized, and this is helping keep a 30-year rate at least at 6.5, and at year-to-date lows 6.5. 6.53 is where we ended yesterday. 6.5 even is the Mortgage News Daily low of the year. The Freddie Mac 30-year fixed weekly came in at 6.56 to end the week. We could see maybe a new year-to-date low, just get under 6.5 here today based on this 10-year momentum this morning, going even a little bit lower. CME Group has a 91% chance that the Fed will cut in just 2 weeks from today. We're 2 weeks out from that meeting, and we'll be looking forward to that right here on the hot sheet, as we do every single Monday through Thursday that the markets are open. Thanks to all of you who tune in and share the hot sheet. If you haven't subscribed, please do so. It's free. It's the free, simple way to support everything that we do at BAM. Let your friends know about the hot sheet. If your friends in your industry, they should know about this. The replays are always uploaded on both Apple and Spotify. Love a review there. And the other reason we get to do this show is we have great partners like Zudelia, which gives their platform away for free to every single BAMX member. They also give us great data like this: top 10 housing markets for cash offers over the last week. In the last week, cash offers, investors, cash buyers were focused on these 10 markets more than any others: Denver, Atlanta, Vegas, Raleigh, Houston, LA, Naples, the town I'm sitting in right now, Dallas, Jacksonville, and Orlando. Okay. When I look at some of these markets, like an Orlando, or no, I'm sorry, a Naples, maybe even a Jacksonville, some of these markets, which only a couple of them are on here. When you get on the other side of hurricane season, I think you'll see more shoreline hurricane. Houston obviously has hurricane implications. If you get past hurricane season without a major one, you'll see more cash moving into those markets. That's just my feeling. There's a wait and see approach. Hey, prices are suppressed right now in the Sunbelt states, particularly Florida and Texas. You get on the other side of hurricane season, right before maybe Fannie Mae is right and transactions increase and maybe rates go down, you'll see them move in. What have I been saying about buyers today? It's better to be early on the herd than late. The early buyer in COVID's the one that cashed in. The one that battled the peak is the one that felt like they might have just a little bit overpaid. And so buyers right now, I feel like, and going into the end of the year, are going to be at the advantage. All right, there's your hot sheet here for this week. Again, love for you to subscribe to the channel. It's free, it's simple, it's right down below. Hit subscribe, hit the notification bell, share the hot sheet with someone who can benefit from a 24-hour look back on housing, and we'll close out the week. Short week. Week's already flying. We'll close out the week tomorrow, 9:30 on the 6:30 on the West. Until then, toodaloo.